In this video, we are going to show you how to correctly understand market structure and how to trade inside the range. Also, how smart money builds liquidity around a range and how it builds positions, and the proper way of identifying break of structure and change of characters.
Get a premium price and sell above the range. You got stop losses, which are buy stops. That is known as liquidity for smart money. That is what large banks and institutions need. It's known as a liquidity hunt. So the smart money grabs liquidity. That means they sell for those buy stops and then they will take the price in their intended direction. What that signals is a possible change of the trend. This is an example for a change of character. Example for a change of character before a trend change. These are the topics we'll be covering in this section. So, what is a swing high? Swing high is a candle which has a lower high candle in both sides of it. So, it's a lower high candle here compared to this candle. What that means is this candle's high is lower than this candle's high. This candle's high is lower than this candle's high. I'm talking about the price. So, this is a swing high candle. What is a swing low candle? A candle which has higher low candles in both sides of it. So again I'm talking about the price. So this candle's low is higher than this candle's low. This candle's low is higher than the price of this candle's low. So that is a swing low candle. Let's see what's next. So the market structure can be in one of the following forms: uptrend or downtrend or in a range. Let's see what is uptrend. Uptrend is a prolonged period of rising prices. So the price is rising for a considerable time period, longer time period. It's often called as a bull market. Overall direction of the price is upwards and it's making higher highs. So these are higher highs. That means this high is higher than this high. This swing high is higher than this swing, higher highs, and it's making higher lows. What that means is this swing low is higher than this swing low. This swing low is higher than this swing low. So higher lows, higher highs and higher lows. Usually traders buy in a uptrend. Prices. So what is a downtrend? The price is falling for a longer considerable time period. It's known as a bear market. The overall direction is going down. The price is going down. It's making lower highs. These are lower highs and lower lows. These are making lower lows. So why is it a lower high? Because this swing high is lower than this swing high. This swing high is lower than this swing high, almost equal. It's going down, lower lows. So this swing low is lower than this swing low. This is swing low. This swing low is lower than this swing low. Traders sell in a downtrend.
Okay, so now let's look at how to correctly figure out retracements or pullbacks.
Retracement is a small pullback in price movement, temporarily moving in the opposite direction before continuing against the current trend. So it's a small pullback. Pullback means, okay, this is an example for an uptrend. So the price is supposed to go up in uptrend. Price is going up. However, you can see small pullbacks. This is a pullback. This is a pullback. This is a pullback in the opposite direction of the trend. So the trend is up, but the pullback, during the pullback, the price is not going up. The price is going down. But after the pullback, the price will continue going up. So a retracement is a short-term price movement. It's a short-term price movement that moves in the opposite direction to the current trend. As I explained here, the current trend is up. Retracement temporarily moves the price down. So why are there retracements? because retracements are corrections in the price that can provide traders with the opportunity to enter the market at a better price. What that means is, okay, in an uptrend, usually traders buy. That's true. However, when the price is high, if you buy at higher prices, you can make less profits. So it's always better to get a discounted price and then enter into the market. Enter into the market means buy. So it's better not to buy here. It's better to wait for a retracement and then to buy over here. Same here. It's better not to buy at this price. It's better if to wait for a retracement and get a good discounted price and then to start buying. It's a retracement during a downtrend. So the overall price is in a downtrend. And then you can see temporarily the price is going in the opposite direction here, here. So these are the retracement legs. So retracements gives traders opportunity to enter the market at a better price, at a premium price. What does that mean? So what that means is, if you sell at lower prices, you can make less profits. So it's better not to sell here. It's better to wait for a better premium price. That's the retracement. That's what retracement gives, and it's better to sell over here. Once again, it's better not to sell here. It's better to wait for a retracement and get a premium price and sell. And this is the explanation of it.
Okay, so now let's look at the concept of a range and trading inside a range.
So what is a range? Price is not in an uptrend or in a downtrend. It's going sideways. So that is a range. So usually traders sell at the top of a range at these points, and traders buy at the bottom of a range. So why? Because at the top they can get premium prices to sell. Why do they buy at the bottom? Because they get discounted prices to buy.
Okay, so now let's look how smart money look at the ranges and how smart money build liquidity around ranges.
So what is above and below a range? So when you have a range, above the range you got buy stops, and below the range you got sell stop. Why is it? Because when traders sell at the top, they put a protection entry to protect their entries, which is going to be a buy stop. When traders buy at the bottom of the range, they have a protection entry called a stop loss. That stop loss is going to be a sell stop. So because of that, above the range you got stop losses, which are buy stops. That is known as liquidity for smart money. About this, don't worry at this stage. This will be discussed further in future lessons. So what is happening inside a range? Large institutions, smart money is building their positions, and what's happening here is also it's building up liquidity in both sides of the range. That is what is happening inside a range. And why is it happening like that is because when you got liquidity, that is what large banks and institutions needs if they want to move the price in a certain direction. For example, if the banks and large organizations want to move the price down, that means they have to sell. But in order for them to sell, they need the opposite party. That means they need someone to buy. So in the previous slide, we said you got buy stops here. So what large institution organizations, what they do is they will sell in large quantities for those buy stops. It's known as a liquidity hunt. So the smart money grabs liquidity. That means they sell for those buy stops in large quantities, and then they will take the price in their intended direction. Once again, don't worry. So why ranges are powerful is exactly what we explained in the previous slide as well. Let's see what's next.
Okay, so now let's look at how to correctly identify break-off structures with chart examples.
So what is a break-off structure? It occurs when an asset's price exceeds a previous high in uptrend. So see, this high exceeds this previous high. this high exceeds this previous high. So if the price exceeds the previous high in an uptrend, that is a break of structure. So it's a break of structure. It's breaking here. Break of structure. Break of structure. So how to identify a break of structure? You look for a new high, right? It's a new high that passed the most recent significant swing point. So this new high passed this significant swing point. This most recent high passes this significant swing point. Now, why is it a significant swing point? Because it caused the pullback to start. Why is this a significant swing point? Because it started the pullback down. Those are significant swing points. Again here, it started the pullback down, so it's significant. So these significant swing points, if it breaks up during an uptrend, that is how you identify a break of structure. And a strong close beyond this point confirms the break of structure. So if it closes strongly, it further confirms the break of structure. That we will show you in the next slides what we mean by that. So break of structures can be seen on any time frame, but they have a greater impact on the market direction when you see them on a higher time frame. So what that means is higher time frames such as weekly, daily and 4-hour, those break of structures are very powerful. So when you make trade decisions, it's better to use higher time frame break of structures. We will show that to you when we do trade examples in future lessons. Okay, let's see what's next. So this is an example for a candlestick example for a break of structure in a uptrend. And this is a powerful break of structure. This is what it said, a strong close. A strong close confirms. What that means is, if you look here, this is very strong compared to this close, because over here it takes the price further up. Like if you look at the gap, for example, when I say gap, how much the price is taken up, that's very strong compared to this break of structure. So that is how you figure out a powerful break of structure. So this is how you will see a break of structure in a downtrend. So this swing point breaks it further down, so it's making a new low compared to the previous low, and it's breaking downwards towards the direction of the trend. So this is a break of structure. Then again it's making a new low passing this previous low in the direction of the trend. So it's a break of structure because it's passing a significant swing point which started the pullback. Break of structure in a downtrend. So this is a candlestick example for a break of structure, and this is a strong break of structure compared to this. Okay, let's see what's next.
Okay, so now let's look at how to correctly identify significant or strong swing points.
Significant swing points. So what are significant swing points? We call them as strong swing lows and strong swing highs. So in uptrend, each higher low candle which caused the break of structure to start. So this higher low caused this break of structure to happen. This higher low started this break of structure, caused this break of structure to happen. So those are significant swing points, significant swing lows. So in a downtrend, each lower high which causes the break of structure leg to start. So this lower high started this break of structure leg. This lower high started this break of structure leg. Those are significant swing highs. Okay, let's see what's next.
Okay, so now let's look at how to correctly identify change of characters with chart examples.
A break of structure suggests that current trend is likely to continue. That means in a break of structure, the current trend will continue. However, in a change of character, it signals a potential trend reversal. What does that mean? So now you know the break. See, the break of structures, this is which shows it. Break of structure indicates the current trend is continuing. But if you see a change of character, it means the potentially the trend will reverse. See, the uptrend after the change of character has been reversed into a downtrend. So how do you identify a change of character? Change of character happens when the market breaks a significant swing point in the opposite direction of the current trend. See, now we explain what are significant swing points, right? So this is a significant swing point. Why? Because it made this break of structure. So if the market breaks the price down in the opposite direction of the trend, so the trend is up and this is a significant swing point which make the break of structure up, but this price leg breaks it down in the opposite direction. So when you break that significant swing point up in the opposite direction, that is a change of character. What that signals is a possible change of the trend. So again, they are more effective on higher time frames. So as you can see, now the trend has changed. Okay, let's see what's next. So this is an example for a change of character in an uptrend. You can see the price was in an uptrend and this is significant swing point and the price has broken it in the opposite direction. So the uptrend now is potentially going into a downtrend after this change of character. And usually before a trend change, you will see a range build up. That is because smart money builds up orders before taking the price down. So usually you will see a range build up so that the smart money can take the price in the intended direction. And over here you see the change of character. So before the change of character, the price was in uptrend. After the change of character, the price is in a downtrend. So this is how you would see a change of character during a downtrend which changes to uptrend. So you can see the price is in a downtrend and this significant swing point is broken up. So that makes it a change of character, and then after that now it has changed the price to be bullish. So this is a candlestick chart example for a change of character during a downtrend which makes it to uptrend. It's in a downtrend and you can see there's a range. As I said in the previous slides, before a market trend change, usually you will see a range most of the times for smart money build their orders, and you can see this significant swing point has been broken up and that's a change of character, and now the price has gone into a uptrend. So before the change of character here, the price has been in a downtrend. After the change of character, you can see the price has gone into a uptrend. Okay, so let's see what's next. So this is another candlestick example for a change of character. So the price is in a downtrend. This is a significant swing point which caused the price to go down, and that is significant swing point is broken up in the opposite direction. So that's a change of character. Also, another important thing you can see is why is it a change of character? Because in a downtrend, it should be making lower highs, lower high, lower high. But after the change of character, instead of making a lower high, it has made a higher high. So keep that in mind as well, over here as well. The lower high is changed into a higher high. Okay, let's see what's next. The trend is valid until the change of character. So as discussed earlier, this uptrend is, for example, the uptrend is valid up to the change of character, and after the change of character, the trend will change in the opposite direction. So the uptrend has now been changed into a downtrend. So we will discuss these topics further in the next section as well. So this is a summary of what we discussed during this session. So we will see you in the next section.